So I was recently on a Zoom call with another trader, and we were talking about gaps. And I realized that I don't have anything put together about gaps on our website or in our YouTube channel here. So that's what this video is going to be about, gaps and trading gaps. Before I start though, this price pattern guide is probably the most successful giveaway we've ever had at NetPicks. And I put it together just to help traders find some consistency or even find a way to start trading. You can download it, it's free. The link is above on the right here, or you can check out the description below. Okay, so let's get back to gaps. What is it? Well, the most common definition of a gap, it's having a price difference between the closing price on one day and the opening of the next day. Simple. But the key is the market has to have a time when it physically opens and when it closes, as we do in stocks and futures. Now, Forex does have gaps that occur between the Friday close and the Sunday open. But in currency trading, we have another type of gap that we can trade, as they are a lot more common, and we're going to talk about that later. And it is possible to trade gap setups, but the key is to know the different types of gaps that you're going to face. So essentially, there's 4 types of gaps in the markets, but you're not going to treat them all the same, because some of the gaps you're going to see will be gap filled, or we call it filling the gap, which just means that price will reverse to the point of origin there's about. Other gaps, they won't get filled, and you have to know the difference, because if you attempt to trade certain gaps and you're fading it, which means trading against the gap, that can be pretty costly. So let's start with the filled gap, common gap. The name's pretty clear, it says it all. This gap is found in trading ranges as well as in trending moves, and they're filled pretty quickly. And given the name, it's really difficult to forecast any future price movement from them. Essentially, price will form a consolidation, price will spike out of it and return relatively quickly, filling in the gap. And this could take on a few different forms, but the concept is the same. And trading gaps like this is a pretty common practice. From an analysis standpoint of the market, if you don't just trade the gap directly, it really does not tell you a whole lot in the way of what the next probable move is. Another filled gap is the exhaustion gap, and this is the second type, and we're going to look to trade the gap fill. And you'll find these at turning points at the top and the bottom of a trending market. Now, the exhaustion gap has 2 variations that traders will term exhaustion. The first one is a gap into a previous support or resistance level. Now, the key is that you want to see weeks of a directional market, as we see here in this example. And you can see that this gap is filled pretty quick. So your gap trading strategy would have a way for you to trigger yourself into a position in the opposite direction of that final thrust in price. Now, some traders will use an uptick in volume, especially after the gap and as price reverses, to confirm the trend reversal. In the second variation, price turns at the resistance level and then gaps down in price in this example for short. So you can also get both variations on that same chart. So if you're involved in the first variation, that gets you in the trade before the second variation gap, which is going to result in some pretty quick gains on your trading position. And if you use gaps just to analyze the market, the exhaustion gap can point to corrections or full trend reversals. The breakaway gap, this one is not filled. So that's the defining feature of this one, is it's not filled, and you have a support or resistance area that's been tested multiple times. So the breakaway gap is a confirmation of sorts of a new trend direction, which usually starts out of a chart pattern like a channel or a wedge. Even breaks of trend lines can have breakaway gaps, and you would want to trade the trend line break a little differently than waiting for a pullback, unless you're going down to a lower time frame. So again, this will not have a gap fill. Now, attempting to fade the break during what appears to be a fill attempt would have you hurting here as price bases and then just gaps again. And breakaway gaps, from an analytical standpoint, they can confirm a new trend after reversal. And this one here was a continuation of the trend after a brief consolidation period. Runaway gaps. Again, they're not filled. Now, this gap could occur at the beginning of a new trend or in the middle of the current trend. And you can even see the runaway gap after the breakaway gap when a new trend is strong. So why does this gap occur? Well, remember that some gaps fill, and in that case, you'd wait for a retracement to get on board the trend so you don't miss the next move. But when there's no fill of the gap, it means there's no retracement in price. And traders that are anxious to get on board, they have to wait for any pause in the price action. And when they get it, they just pile in, which just drives the price. This example here is a 1 hour chart. And if you go up in time frames, you can have this pause here as just one bar. And you can see that price broke to the downside with no gap fill. So the first time to get on the move was at this first pause. And traders who are waiting to get on the train generally cause that gap to take place as they all pile in. And this is why sometimes going down to a lower time frames, you can find these pauses. Whereas on a higher time frame, it would just be one candlestick and it may not even look like a pause. If you're looking at it from just the way you're looking at the market, from the analytical perspective, you're looking at a market that is in a strong directional move. And if you attempt to fade this price, you're going to be hurting. Gaps in liquidity. There's another type of gap that you should be familiar with, but it's not a physical gap that you're going to see in your chart. What you'll see these as are long candlesticks or long bars on the chart. Now, if you look at this one here, the size of this bar compared to the other ones on this chart. Now, these are useful in the same locations as the physical gaps that we just talked about. And you wouldn't trade these ones any different than the ones that we just talked about. What about strategies? Look, we don't need to list out a ton of trading strategies for gaps because in the bigger picture of things, we're looking at two variations. We're looking at gaps that get filled and gaps that don't. So for a gap that gets filled, let's talk about a mean reverting type of strategy, which means we can look to fade a certain level or look at a reversal chart pattern. So once you recognize that you have a gap that will probably fill, you want to consider using a stop order to enter. And in this example here, it would be when that doji breaks to the downside. Now, traders will often use a multiple time frame approach. By noting that the common gap occurs, they'll go down to a lower time frame and they'll find a reversal pattern or a trend line break. And this is a 4-hour chart of the same area of the last chart. So we have a few choices for entry, and that includes a double top. So why would I not short the range at the high of momentum on that gap bar? Because when you have basing at the high of momentums, that is a bullish setup generally. The probabilities are it is a bullish setup, although it does not always mean that we're going to get a strong continuation, as you see here. Now, what about gaps that don't fill? It's really easy to jump into a trade when we see some heavy price action, but that's a mistake. We don't want to miss the trade. So we got to find a way to enter that has an edge, no matter how slight that edge may be. So there are many ways to enter these types of trades. In this example here, you could trade the trend line break. You could trade the rejection of support or an indicator type of trading trigger. But the key is you have to look for some type of pause in the market that allows you to jump into the trade. Ranges and pullbacks are the pretty simple choice. Let's wrap it up. The toughest part of trading gaps is distinguishing which ones have a risk of getting filled or to keep running. The type of gap that you trade is as important as how you're going to enter it. So the basic concept is gaps that fill. Think mean reversion, which requires some type of reversal signal. For gaps that don't, you need an entry that uses some type of consolidation. So whichever you use, the trade entry is only part of that trade. Risk management and your stop loss is vital, especially if you get it wrong, which you will at times. We all have. Thanks for watching. Hope you picked something up.